Larry is an excellent trader with a very strong background in the markets. And Larry, if you can, I know we're not getting started here for another minute or two, but could you possibly just kind of give everyone here, I know some of you guys have probably heard Larry before, type in a yes or no whether or not you've heard Larry present before, a yes or a no for us. I know I see a lot of the TradingPub regulars that have been here, but looks like we've got some new people for sure. Okay, no, 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 yes, yes, no, no. Okay, good. So looks like we've got some new people in the crowd as well that haven't had the opportunity. Well, I can tell you, you guys who have heard him before who answered yes, you definitely know.
I'm going to get started. Can everybody
Larry,
hear me okay?
You can go ahead and take it away.
Mic test. Can you hear me okay? Testing, testing, testing. Okay, great. All right, so let's get started. First off, I hope you're enjoying your summer. And I appreciate Morgan having me here today to give my presentation. So I always enjoy coming to TradingPub and having a great audience here. So thank you very much for showing up. First off, let's go through the disclaimer. The following webinar is purely educational. Any stocks or futures do not constitute advice and should not be construed as recommendations. This is purely educational, for today. I'd also like to give you my free ebook. If you just go to my trading site, powercycletrading.com, I'll put that URL in here. And I've got a couple really good books. One is on 15 option trading strategies. Just put your name, email address in there. And I've got a second ebook on futures. So if you'd like both of them, please get them today. I also have one thing I'll be giving away as a nice course. It's a free course to everybody that's registered here today. And here's the URL for that. Just go to that particular site. And what you'll get, and it's free, is my Option Trading Made Simple course. So just put in that URL into your website. Put in that address right there, powercycletrading.com/pub2. And just put your name, email address in there, and you'll get that free right away. So it's a great course to teach you how to select strike prices, and it's free for you guys today. So it's called Option Trading Made Simple, and it's a practical way of trading options, really focusing on option delta. And today most of my presentation will be on options and primarily focused on weekly options. So this will really complement what I'm going to go over with everybody here today. So what we're going to cover is 5 essential steps for trading weekly options successfully. And we'll start out by how to let winning trades come to you, scanning for the best trade setups, how to capitalize on powerful volatility, compression breakouts, mechanics of weekly options, and best weekly option strategies to use. But first, let me start off by giving you a little bit of background on who I am. Over the past 3 decades, I've been actively trading in the financial security markets. I was executive vice president of one of the largest international oil trading companies in the world, and I managed their international oil trading securities for over 10 years, where we traded, and managed billions of dollars worth of oil, foreign exchange, and financial market derivatives. My trading group was one of the first to trade over-the-counter options on cargoes of foreign crude oil, and I literally traded millions of barrels of these crude oil contracts. I've been trading options for over 26 years and started trading weekly options back in 2010. But my quest has always also been to develop a system that worked regardless of what the markets were doing. And this is what I put together for our members at PowerCycle Trading. So I put together, what I learned over my trading career, and I created a 4-step trading model that anyone can use to improve their trading. So it's something that's really beneficial to everybody at my website, PowerCycle Trading, all our members in our virtual trading room. This is the trading model that we use for all of our intraday and swing trading. First off, how to let winning trades come to you. There are 5 key elements that every trader needs to have in place regardless of trading system or trading methodology. First off, you want to have a plan to govern all of your actions. You want to be disciplined in implementing to that plan. You want to learn to patiently wait for the highest probability trades based on the model you have chosen. You want to allow the trades to come to you instead of chasing trades. And you want to create structure in your trading with set goals, rules, time frames, hours, and your risk control. Now, these are all simple guidelines, but sometimes the simplest things are the most difficult to put into action. So what I recommend is that you use a trading model or a system where the rules are clearly defined. Now, this makes it much easier to implement to those rules or to a system. And I use a rule-based system, which I've developed called the Power Cycle Trading Model. And the rules of this system are based on 4 powerful indicators that will define price cycle change by identifying a defined price range, price volatility, change in price cycle, change in price cycle momentum. Now this provides us a set guideline which we use and allows us to let the trades come to us or let the trades come to you. So whatever model you use, know your guidelines and rules and then use those guidelines and rules. Now, excuse me, for all swing trading and day trading, we will use 2 to 4 different time frames for all trade setups. And this is what we call a trade confirming process, which allows for non-emotional trading. So the end result when you have a rule-based system is that you have these rules that are governing your trading, and it's makes the decision based on your model. And not, letting your emotions of fear and greed interfere or enter into the equation, which often sabotage, a trader, leading, you to overtrade or give back profits. And so one of the key elements that I try to really focus on and point out to myself, plus all of our members, is to, have that methodology or trading system, follow those rules, and let the trade come to you. Don't chase the trades. Be like that cougar sitting in the bushes waiting for its prey to come in and just wait patiently for the trade setup. Once it's there based on whatever you're using for your trading system or methodology, then make sure you execute and trigger and take that trade. So that's the key to it. Take the trade, be confident in your system. Now, I'm going to show you just a little bit of our system just in case you're wondering what we use. It's a 2-part system. This is the upper studies, and then we have the lower studies, which I can't show you. But it is a proprietary model, and it can be adapted and used on any platform. I have 3 signature courses that are available on my website that are for sale, and this one happens to be our customized indicators that we've customized for Thinkorswim. So we have a lot of different visual aspects to this model. We have Fibonacci retracement levels. We have support resistance that are based on prior trading ranges and time frames. We have automated trend lines, and we have the lower studies, which actually give our indicators that we use to actually give us our entries and setups, plus the upper study here, which shows volatility constriction, or what we call a compression, and we also can show breakouts based on this. So it's a great trading tool that we've developed. We've got a couple of very nice trading tools, and this is one of them. Here's a couple of trades from today. Here was Apple. This was an Apple 5-minute time frame. This was this morning right on the open. Got a buy signal here, had a nice move up. And then most of the day you can see it consolidated sideways, and this is what we call volatility compression squeeze. And our model of indicators that we use will actually show when this compression starts, when it ends. And when it ends, a lot of times those are triggers for a very good volatility breakout. Here's another trade. We trade, gold, crude, Apple, whatever's moving, and then, use a lot of weekly options if we can for swing trading usually. And here's just a trade this morning. This was early based on our system on gold. Nice breakout. Here's another trade earlier today on gold. This was a volatility compression breakout to the downside. You can see where it was triggered. The end of that period right there, trigger on that bar. Had a nice move to the downside. And here's crude oil. Do a lot of crude oil trading as well. So here's where the actual model was indicating a cycle change to the downside. Here's a trigger where it went short right here. So that's just kind of an overview of what we're currently using, and we use that same model, but based on different time frames for our intraday day trading, and we'll use it, for whatever. I mean, we can use it for Google, Apple, futures, Forex, whatever you want to trade. Same indicators, just we just adapt the time frames, and then we use the same model for our swing trades. So the next thing you want to do is be able to have some type of way to scan or screen for the best trade setups. And it's important, you can spend a lot of time going through charts, each day or at night, and you get really overwhelmed. So if you have a good trading tool, which is some kind of screener or scanner, it sure helps as far as finding those trades. So, one thing that we've put together is our scanner, which I'll show you in a minute, but I believe all traders recognize that markets move between quiet periods and volatile periods, and skilled traders should be getting positioned during the quiet times in order to take advantage of the inevitable spike in volatility that usually follows. So at Power Cycle Trading, we call this phenomenon volatility compression breakouts. So once a stock has been identified to be in a volatility compression, then as a trader, you have time to construct a trade setup that will take advantage of the volatility spike that usually will follow. And this is what we refer to as momentum breakouts up or down. So these breakouts are usually very strong and fast, which is perfect environment to capture profits for both weekly options on a day trading basis or even a swing trading, or just for our futures day trading like I showed you a few of those just a minute ago. So this is kind of a overview glimpse of our scanner, and it's made up of a matrix, and we have time frames from 1 minute to 1 month. And then within the matrix, here's a better look at the matrix. So within this matrix, it's based on our trading model rules. It will scan across the universe of stocks or futures, Forex, whatever you want to look at, using our rules of our model, and it'll break it down on a 1 minute, like I said, to a monthly time frame. So on this matrix, I've got it from a 5 minute, 15, 30, 1 hour, daily, weekly, and monthly. And then we have it a ranking, a numerical ranking from 1 to 5, 5 being the strongest. And then we have it color-coded to be green if we are in a volatility compression, or it's just white if there's no compression. And then if it's a negative, that means the probability of direction to the movement is down, or if it's a plus or no negative, its probability of the movement is to the upside. So here's just a kind of a mystery list that I put together of the things that I like to follow. You can put anything you want, and then it's a real-time, constant updating of the model. So on a 5, 15, 30-minute basis, it's constantly grinding through the data and spitting out the parameters that we put in our model, and if it identifies something, it puts it up on our matrix. Now, once we have it on our matrix, then you can, if I back up a second, you can have it linked to your chart. So like right here, I've got this, you can see it was linked to this FFIV chart. So I could click on FFIV right there, pulls the chart up, and I can immediately the chart based on my model parameters, which are, would be on the chart. So it's a really helpful tool. And what we really like to look for are these compression breakouts. And so here's a compression breakout when it started on a 5-minute time frame, the dot right here, and then you can see when it ends, and then you can see the compression, the volatility spike to the upside. Now the other thing that we will use is our actual model, which would be the lower studies, which you could not see, which actually gives us direction. And then we also incorporate trend lines. So here's another example. Here's an Apple 60-minute time frame, and we'll do this, whatever time frame. I'm going to usually monitor a 5-minute, and I'm going to monitor the 30, 60, daily, weekly, for these compression breakouts. Now here's a really nice compression breakout. On Apple, this is back like in November. This is just an example to show you that compression started, got tighter and tighter, and the compression broke, and it triggered to the upside. And it's basically volatility. When you think of a compression, think about somebody pushing a spring down, compressing it, and finally you get it to that point where no amount of pressure can keep it down any longer, and it finally expands and blows, and breaks out with this tremendous burst of energy. So that's kind of the concept. Here's another just example. This is on a daily time frame. This was on crude oil. You can see where the compression started on that dot and just went on for quite a few days and then triggered. And these will usually have a follow through of 5 to 7 bars. So when you see a compression starting, then you can kind of get weight ready and put together a trading strategy that you want to use. You might want to just buy the stock outright. You might want to use options. So I like to use options, and I like to use weekly options, which I'll go through in detail here in a bit. So once you have that scanner, which we have, that's a tool that we also provide and that you can buy. It's on our site, powercycletrading.com. You can use that to your advantage to find these trades real quick. And what I tend to do is just follow the same list of about 5 or 10 high beta type stocks over and over and over. Like Apple's probably my favorite. And I like to follow Google and Netflix, all the kind of usual characters, Priceline, those things. They can be very explosive. So when I see a compression squeeze, then it can get pretty exciting. So the next thing you want to incorporate is how to capitalize on these powerful volatility compression breakouts. And one great way to do it is through the use of trend lines. So it's important that you understand trend lines and how to draw them. So, you saw this example earlier, nice break to the upside. Here's that trend line break, burst to the upside. Here's a trend line break to the downside. Here was on Apple. This was on a daily. You can see when the compression started, and then that trend break, boom, acceleration, great momentum to the downside. So the key to it is to make sure that you know how to properly construct a trend line. And I'm going to teach you that today if you don't know, and then you can use it tomorrow in your trading. And so it'll help you right away as far as giving you an extra tool that you can use tomorrow. So basically, what is a trend line? So supply demand dictate price movement and the use of a trend line. And trend lines, are universally used, but the construction can be very dissimilar from one person to the next, causing it to be kind of a subjective interpretation. It's best if you have rules to govern the way that you create your trend line. So what we use is a trend line setup based on pivot points. And so you can define what a pivot point is, and then you can actually define it and have it coded and put it right onto your computer to have it automated, which we've done. So this makes drawing of a trend line mechanical, systematic, and then you can actually incorporate it and make it automatic. So first we'll go through a supply pivot point, and this is when you have a price high that is not exceeded by the prior price or the price immediately after. This is what we call a pivot high. So a very simple example here. This is just a chart of Apple. This is a 5-minute time frame. And so what you want to do is, I'm going to get a drawing pencil. Most recent price is more important than historic price. So you want to start, you want to know where recent price is. That's what's going to tell you which way the market's going to go in the future. But we will incorporate past price with it. But what you want to do, or what you don't want to do, is you don't want to start at the left of your chart, which is past historic price. You want to start at the right side of your chart, which is current price. So just start on the right side of your chart, come in, find the first pivot high you can. So this is what we call a pivot high. And that's where that bar, whatever time frame you're using, is higher than the bar before and higher than that bar after. So once you find that first pivot point coming from the right, then you go up until you find the next one. So that's right here. This bar's higher than the one before and the one after. Then you extend that line down, and you've got a really nice supply line, and you can see the breakout to the upside. So it's a very nice defined way to do it. Makes it automatic, makes it the same way each and every time. So that's basically it. It's that simple. And now you can see here's our automated trend line using the same rules. We just plugged it into the computer, and the computer draws it for us. So here again is the come from the right side of the chart. Computer sees that first price right there, higher than that bar, higher than that bar. Computer looks for the next price. It's right up here. And we have it a little different because here's also a pivot high. Could have been, trend line there. But we count a number of bars. We've done some testing and stuff, and it's a little bit different, but the same concept. You don't have to have number of bars. You can just do it the next pivot high that you see. So that's basically how it's drawn. Here's another example, just so you can kind of get the concept down. From the right side here, here's your pivot high, extend that line down. Here's your supply line, break out to the upside. Now the other thing that we incorporate, we'll incorporate with our model, this is our systematic drawing that we have. We use pivot high extension. So here, see this pivot point here, this high? This will be an automated line that comes across. And so what we'll tend to do is, to give ourselves a little slack, we would wait for this to break above this pivot high extension and then get in. So a lot of times you'll get a break of a trend line and then it'll retrace and take off. So I want to give it a little bit of room, in case it's a false breakout. Sometimes you get these breakouts that are, what we call a false breakout. Here's another example. This is a FFIV. No, this is a Visa. This is on a 400 tick chart. Here's a high, pivot high, trend break to the upside. Now the demand pivot point is just the opposite. It's when you have the lower price, lower than the prior price and price immediately after. That is what we call the pivot low. So just the same thing, but just the opposite. So we're going to come from the right side of the chart here, rather than the left. So we're going to be looking up here. We're going to be right here is that first pivot one. So here, that pivot point there, that low is lower than the bar before and the bar after. Come on down. Here's pivot lower than that bar. Extend the line up. And there we go. Demand line, break, downtrend, nice momentum to the downside. And here's, an automated look. So pivot low, extend up, nice pivot low here, pivot low here. Now here's our pivot low extension. So here we got a trend line break. Here this was a gap down, so because this came the next day. But a lot of times you're going to get a break of a trend line like this the day before, and you should usually, we usually put on something if we want to take the trade, because then you have a high probability to get that gap down, which is really nice if you're short. So those are components that we want to use for our trade setups. So then it's a question of, okay, do you want to just use the underlying, which you can. You could just go long or short the futures, or you could go long or short the stock itself. And then what we will do is we will incorporate weekly options. So you can have number one is price direction is probably the key to your success as a trader. So if you don't have any sense of direction, and your direction is usually wrong, it doesn't matter how much you know about options, you're not going to make any money because your direction is going to be off. Even if you're non-directional, a lot of times you still need to know that direction. So if you want to make good money, you need to know direction. So in order to have direction, you need some kind of system. So that's what we start out with, our fundamental system, and then we incorporate the weekly options. So weeklies are one of the most lucrative and still unexploited opportunities that exist today due to defined risk, low cost, and high levered returns. New trading vehicles, are rare. Consequently, they provide an untapped fertile market to those that are willing to expand their knowledge and expertise and learn how to use them. So weekly options, they've been around since about 2005, 2006, but they really didn't start rolling until about 2011 or 12, and now they've been picking up a lot. But they now account for 12% or more of the 300 plus million options traded every month. Some of the more exciting stocks, Apple, Google, Amazon, now account for 40% of their volume. So weeklies, they come out every Thursday and they'll expire the next Friday, 8 days later, the next Friday 8 days later. So, based on the short duration of time, they're very cheap, and I'll go through how that works. Since expiration can be within days or even hours, the at-the-money weeklies can be purchased for as little as $2. They have unlimited profit potential, 500 to 1,000% or even more. It's a very irregular happening, and sometimes this can even happen in one day. So, contrast that to monthly options. There's no comparison if you know how to use the right strategy and the time to put it on. They're easily traded, just like stocks. Their volume is high. They're very liquid. Some are more liquid than others, obviously. Apple's the most liquid. And they provide abundance of low-risk income opportunities due to their short duration. So they provide you 52 times a year to profit from low-risk, non-directional, or directional income strategies. And also last year, in 2010, the option exchange expanded the amount of weekly options from 1 week to 5 straight weeks. So, it provides even more opportunities for income type strategies or even hedging. So the mechanics, key to understanding the mechanics in order to know how to use the strategies. So based on the weeklies, I put together a lot of different option strategies to take advantage of the 3 key elements that they offer. And the main elements are time value, implied volatility, option delta. So the combination of these key elements, when used correctly, creates a trading formula for you. This formula, especially when you combine it with a directional price model, delivers you a high probability trading methodology with great profit leverage. So that's the key. So if you have a directional system that you like or methodology for your timing, and then by combining that with the weeklies, due to the elements or components within them, you can get a great kind of different trading methodology or system altogether. So the first thing is just to understand, okay, what determines its price? So an option price, time value times implied volatility times intrinsic, extrinsic value. And, I won't go through in detail all the Greeks, but the main key components for today, for what I want to show you, is the time decay element. So here's your time curve for a weekly option. So, it comes out on a Thursday, it's 100% time value. And then it decays, accelerates until it's at 0 8 days later. So you basically have 6 trading days, to take advantage of this. So it's kind of, I tell our members, it's kind of like a hand grenade. You're just, if you're not careful, sooner or later it's going to go off. It's kind of like that time eventually runs out and the thing explodes. So that's a bad thing if you don't know how to use it. But if you can know how to put the time decay in your favor, it can be a very, very big plus for you. So basically 8 days, that's devalues or decays by 1/8 every day, or about 12–13% each day if the price doesn't move. So here's just a table to illustrate that. So on Thursday, you have 100% implied 100% time. Then you go down by 1/8 Friday, Saturday, Sunday, Monday. Monday you come in after 2 days of the weekend, you're down to only 50% left of your time value. So you can see how that can fall off dramatically. Now here is just keeping the intrinsic value, extrinsic value at 1 constant just for this illustration. So you can have the implied volatility go up. Here I jacked it up to 800. On Monday, the time value was at 50, so you can see that your premium barely went up. So these are things that you need to be aware of, because if you just sit on a option, eventually, it just goes to zero, you lose money. So the next thing to do, here's just an illustration to show you that, a different example. This is Apple. This is back in the good old days when Apple was trading up over $600. Here's your strike prices. Now this is a weekly option chain. Below is a monthly option chain. So here's your delta right here. Keep the same delta. We're going to do something close to the money, at the money. So the 640 strike right here on the weekly, you can see is 5 at 505. So remember, one option contract equals or controls 100 shares. So it's equal to 100 shares of stock, basically. So you can see the weekly option here, the 640 strike, you can buy that for $500. The strike below, the chain below is the monthly, and we'll look at the same delta. Strike here is 640. Delta is about the same, 55, but look, it's double the price. So it's 1,050 at 1,060. So, which one, if you had your choice, would you want to take? Well, if you could quickly take advantage of it, because directionally you have a good feel that the market's going to go up, I'd want to take the weekly option. It's $500, so if whatever I make on that, my return on capital is going to be nice, plus my defined risk is going to be half the cost of the actual monthly, and just a fraction of the cost of if I bought 100 shares of Apple stock. So here it is, another kind of layout for you to make it even more explicit. So here's Apple. It's at $640. We're using that as a comparison. Now we're using 100 shares to make it equal to an option contract. So if you bought 100 shares of Apple at $640 a share, that's $64,000. Now if you made $100 on that, or $1 share, your return on capital is 0.16. Now if you go down to the weekly 5 days expiration, have that 50 delta. So you take that and you made that same $1, which is $100 on that one option contract. That's a 20% return. It's 100 divided by 500, 20% versus 0.16. Now here's your monthly option, same option delta, 12 days, just 12 days, 1,050. So that same $1 equals 100. So you make 9.52. So if you had your choice, it's a pretty easy choice. You would prefer to take a 20% return on your capital, only risking $500, making the same amount of money. You'll take this all day long. So that's just to give you a good visual overview of how it works with time value, and that's one of the key components. So getting that out of the way. So if, as a trader, which weekly option strategy to use and exactly when to execute that trade, then the weeklies can be used to produce some exceptional fast profits due to the incredible leverage they provide. So you can see that if you now can take advantage and use those benefits in your favor, you've got some tremendous potential upside with a low defined risk downside. So based on the dynamics of weekly options, my strategies capitalize on these benefits for trading the following market conditions. So I put together a number of strategies, and I like to look for reversal trades. Momentum breakouts are big. I showed you a few of those and how we look at those. Retracement trend trades and high beta earning trades. And then expiration, directional, non-directional, delta neutral type trades, and directional Friday expiration trades. So I've kind of got my trades all broken down in these types of different trade setups. So I'm going to show you a couple of different trading examples here today to show you a couple of different trading strategies that I like, and to show you the tremendous benefits that they offer through leverage if you know how to use the strategy or when to use the strategy, and then construct it and manage it. So the first one that's a pretty interesting trade strategy is the back ratio spread. And this strategy is really, really cool. It's one, though, that you really have to have a good directional trading system or some methodology that you use where you're looking for either a major reversal in a market or a major breakout, trend type breakout. Because these types of trades, especially if you use weeklies, you want them to happen fast and be explosive because of the construction of the actual trade. So this is one. This is a really pretty interesting one. This was collecting a $40 credit, weekly option credit, and this trade turned into over $930 per contract gain in 2 days. So you wonder, okay, what is that? Well, should have started with that, I guess, and not given it away, but it's the back ratio spread. So here's the trade setup. Again, you don't want to do this trade, or any trade for that matter, unless you have a good sense on direction. So this was Apple. This was on the 19th of, let's see, this was on the 19th of July, I believe. Let me see. Let me go forward here. Actually, the 19th of June. This was just the daily chart today. But here's the number one. This is what we're looking for, is this compression breakout. So here's the compression started here on the 8th of June, and then it went on for about almost 2 weeks. And then here's June the 18th, and it triggered the 19th, had a nice trend line break. Our model went short, and so here, here you could just go short shares. Great move to the downside. Or you could do, a put spread. You could sell a vertical call spread. Now, the other thing that I do is I always want to know where the implied volatility is versus historic, and I have a certain procedure that I step through for that, just to, give me the option if I want. Maybe I would prefer to sell a credit spread, and maybe it tells me that the options might be overpriced because of the high implied volatility. So I'll go through that. I'm not going to have time to go through my process on that today. But if you're, one more thing I'd like to put out is that if you're interested in learning a lot about weekly options, I've got a full course. It's called Boot Camp on Weekly Options. And I just did this boot camp about 2 weeks ago. And it was a full day event plus follow-up. And it basically taught you every weekly option strategy I use, the system, how it's used, all my little secrets and stuff that I've learned over the years. So if you'd like that, it is available on my site, Power Cycle Trading, so you can go there and look under boot camps and find that course. So here's just the trade setup. So here's the actual trade and what it looked like. So this is buying the 434.25 back ratio put spread, and in the course it goes through all the details of how you set this up. But on this particular trade setup, you want to try to get these as cheap as you can, and sometimes you can actually collect money. In this particular one, $40 credit was actually collected. And then 2 days later, it exploded to the downside. You could see this is what you're looking for. It's actually that same day. I mean, it just exploded, crushed, just collapsed to the downside. So you can see this thing has unlimited upside because it's you're net long more puts on this particular one than you are short. So it's 2 to 1 on this particular one. You can have it 2 to 1, 4 to 1. You can have different ratios, but I usually will just use a 2 to 1 ratio. And question, what system to use to identify direction? Well, we use our trading model, the Power Cycle trading model. It's a cycle model. It shows cycles, cycle lows and highs, and also these compression volatility breakouts. So if you're wanting to learn more about that, go to my website and you can look at the systems. We have 3 different courses. They're very reasonably priced, and with each course It gives you the trading model, how to set it up on your whatever platform. You can use it on NinjaTrader. You can use it on eSignal, TradeStation, Thinkorswim. I use Ninja, Thinkorswim, TradeStation. You can use it on any of them. Put the indicators in there. It teaches you how to use them. It's got all the videos for that. And then you'll also get time in our trading room, virtual trading room, which will also show you, you can come in there and see us use the model live, and that helps you as far as learning it to see it in real time. So go there and check it out. But this particular model, then you can use it for longer term trades too. You just adjust the time frames, which is taught in the course as well. So in this particular trade, we had the direction perfect, we had the strategy perfect, and this, was $930 in 2 days. So here's what it looked like. It's just kind of a little summary of the profile here. So you can see here the cost of the trade was a credit of $40. The max loss on this, the way that these are constructed, you have a certain point between the strikes where you can lose. This particular one, you could lose a potential 460, and that would only happen if you fall right between the 430 and 425 strike at close, which the odds of that are very, very low when you have these momentum type breakouts. So the cost was, well, you collected 40. Here's the P&L the day it was put on, and then here's 2 days later. So huge move to the upside. Your risk is totally defined and unlimited upside. Here's another one. This was on the 28th of June. So again, another breakout. Here's a trigger on our 5-minute. Here's a squeeze, compression squeeze, breaks the 5. Here's another breakout there, just kind of taking you through the progressions of it. And this was on the 28th of June. You can see a nice trend break here. This is on a 60-minute. Here's your pivot high, breakout. And a lot of times these trades will happen towards the end of the day. So if you get the trend break and are long, I usually just jump on it and take the chance that the next day it's going to gap up. Now this one, you can see it came back down a little bit and then exploded to the upside. And so this was the thing that really set this trade in motion, was that this huge move down, you had this reversal pattern, and then you had the breakout that I showed you on those other 2 slides before. So here was the trade. This was a hope I have the right spread up. Yep, this is it. This is a back ratio call spread. This is the 400 395, and you can see here the open P&L about 50. Now this is what the construction looked like doing this 395 400 callback ratio spread. The cost getting in at 96.5 on the 28th, and the cost at that time was 157.50 per contract. And on the 3rd, the thing had blown out to 1585, so over $1,400, over 900% return, and a 200% return on risk at total risk, capital at risk. Here you can see the trade. See the cost was 157.5. The potential loss was 657, but it is defined, totally defined risk, and rarely, you're never going to lose that whole cost. What's going to happen is that if you close on either side of the 395 or 400, your max loss will be just the cost of your trade. Where you lose the maximum risk is if it was to close between 395 and 400, a $5 spread, which that's not usually the case when you have these explosive moves. It's just, nothing's impossible, but that's highly unlikely. So here's another one. This was actually on Friday. So here, exact same trade setup. Apple breaking a trend line. This is the daily. We had a long setup on the daily. Had a long setup on the 60-minute time frame, and broke to the upside. And here's the trade setup put on Friday. So this is buying the 440, 435 back ratio spread. So on this, you can see the 440 calls were going for 525, buying two of those, selling the 435, and you can see how it exploded today. So this today, when I came in, was, that spread was put on at 250 a contract. Today, the spread was over $500 a contract. So those are really cool trades, but again, it's one that you need to have a little bit of experience. The main experience, though, you need to have a system that you can use to spot these type setups, and then time your entries. So the other one that I like is I love to trade in earnings. A lot of people are scared to trade during earnings, and rightfully so, because volatility is out of control. But whatever's out of control, if you can figure out a way to use it to your benefit, then you can harness that high implied volatility and spikes in price to help you make some good profits and trade during earnings when everybody else is too scared to do anything. And the thing that is cool about it, it's non-directional. I had a question about what strikes did you use, and how do you set your strikes up? The other thing that I teach in the course is how to what we call target analysis. So you need to understand price and where it's going to move, and there's a certain process for that, which I teach you how to do that. So it's what I call a progression, a trading progression. So you need to have steps: step 1, step 2, step 3. Go through these, check off your checklist, and then do the trade. First thing you need to spot the potential for the trade. If you don't have any idea of a breakout or reversal, then you don't want to be doing these type. Good system or some type of methodology where you can look for breakouts or reversals, then these are great strategies to use. Now, my course teaches you all this. Now, I also have an earnings course that you can, if you're interested in that, I'll give you the discount code on that. It's on the website, and it's called Earnings Game Plan. And here's the code. It'll teach you all these. It'll basically teach you this strategy I'm going to show you next, and some other great earning trades. So go to my website, Power Cycle Trading, and then go to courses, or even on the front page, front page of my website. If you look over to the left, you'll see a dog with a bunch of money in his mouth. You can't miss it. Just click on that dog, and it'll take you to the course. But this course, it's a $147 course. Put in that code, and you'll get, that stands for discount 33%, and you'll get all these a lot of these strategies. Now this iron condor strategies in there, and you'll get all the details. But these are two iron condors. These are direction kind of neutral. This one I'll show you on Apple, on the current earnings that came out on the 23rd, and then on Baidu, earnings that came out on the 24th. So basically on this, you need to do target analysis, and I'll teach you how to do that. And here you can see on this particular trade with Apple, I've got a couple ways to measure volatility to give me a direction as to how much Apple or whatever the underlying will move. So I explain that and lay that out in the course. I've got some great resources to teach you that. But once you have an idea of where the potential move can be, then you can construct a trade that will be under the maximum move. So for example, on Apple, it was trading right here at around, I think, 434 before earnings came out. It was trading down here, excuse me. Apple was actually trading at 420 right here. This was Apple on the earnings date right here, the 23rd. So it came down here, and based on the analysis, I think the potential move was looking for a 6 to 8% move on Apple. So what I will do, so if the projection is for whatever it is to say move 6%, I want to set my trade strategy where I make profit if it at 3% or 4%. So, I'm under in case it misses. So you don't know for sure if it's going to move 8 based on the projections of analysts and the tools that I have. So I'll set it below that for 3 to 4. On this particular trade, I did this iron condor set for a move of Apple of 4%. So basically what this was an iron condor. Selling an iron condor is basically 2 different spreads. It's a bear put spread and a long call spread. So I did the 420, 415 put spread where I bought the 420, sold the 415. So I want Apple on expiration on Friday, last Friday, to close either below 415, or my upside spread was the 430, 435 call spread. I needed Apple to close above 435. So here, these are basically, you can do them as 2 separate spreads, or you can do it, all together. So you can see here was a vertical put spread, cost me $205 contract. Below is the vertical call spread, cost $165 contract. So the combination of those 2 together, that's your cost. And then what you want is for it to explode up or down, either outside of your wings. So you want it to be outside the 415 on the downside or above the 435 on the upside at close on expiration. And you don't even have to go to expiration, because when these things move on earnings, a lot of times you can just get out the next day. You won't get your full potential, but pretty close to it. So this particular spread costs $370. Okay, so that's the max risk. You've got that defined, $370. And your potential profit is the difference between the spread, the 420 to 415. So you'll make it on one side or the other usually. So your max profit on this is $130. Now, that's $130, but that's a pretty good return on your capital over a 1 or 2 day period on a neutral type of directional, non-directional trade. So you can see here on the 26 Apple, the options, you can see the puts were at 0 because Apple was trading at 440. The call spread, which was put on at the the call spread was 430, 435. It was well over 435, so you made the whole maximum profit on that. So what you lost on the put spread, you made everything on the call spread, so your net effect was $130. So that's your iron condor. And now here's Baidu. Did you try the OLC 33? Did that not work? That's not the right one. I'm just looking. I don't have it up right now. So it's either OLC, excuse me, or OLT. I think it's OLT. Let me see, hold on. Sorry about that, guys. Let me just double check. Oh, okay. Thank you. Yeah, so just put in OLT, put that in when you check out, and it'll drop it to, it'll be $99. So here was the short iron condor on Baidu. And again, here's Baidu earnings. They were on the 24th. And you see this is what you want. You want an explosive move to the upside. And so this trade was based on Baidu, I think, moving 4% as well. So here was the Baidu. Here's your iron condor. The maximum cost on this was $205. So that's combining the put spread and the call spread, $205. So on this particular trade, if Baidu closes above the wing of the upside was to 120 right here, the 120 call, or if it closed below the 108 call, your max profit, you're going to make a max profit of $295. So here was Baidu on the close of Friday, 298 bucks, so max profit. And because Baidu, look here, blew to the upside and closed way over the 120, it was at almost 130. So those are some of the trades that I like to, I'll have a lot of different strategies, but those are just a couple of them that I wanted to highlight. Now, one that I'll leave you with, just to show you the explosiveness of weekly options. No, the question, wouldn't the loss of a back ratio spread be unlimited? No, you're defined, your loss is totally defined to the put. So you're short a put or a call that's in the money. So you walk through it, just walk through it, and you'll see. I don't have time here to go step by step through the math, but that's the beauty of the back ratio spread, is that your profit is unlimited and your cost or your loss is defined and is capped. So here you can see, here's your profile. This was that back ratio spread on Apple. Here your cost, total cost, $157.50. The maximum profit, infinite. Max loss, $657. So, if you want to learn the full details of it with the profile and everything, please, join me at Power Cycle Trading or buy the course, and it'll teach you the math and everything behind it. So that's the beauty of this thing. It's defined risk, infinite profit. There's nothing else like it. So even if you don't know how to do these trades, now you've heard about it. Now I'll leave you with this one last trade. Now this is called the Lotto trade. These are very rare. I mean, because I'm not looking for them too much because I'm doing so many other things, but they do happen, and this shows you the huge leverage that, and time decay and implied volatility when it's at zero, what these weekly options can do. So this was on a Netflix, March 16th, 2012. Had a, go long, boom, had a nice setup. You can see Netflix was trading 108, just blew to the upside 124. Here's a 30-minute time frame. Here again, trend line break, moves to the upside. So here was the trade. So instead of buying the stock outright, on this expiration day, the 110 calls were going for 11 cents or $11 a contract. That about an hour later, these 110 calls were at $174 a contract. So closed out at 127. So 127 less your cost, $116 a contract. Over your cost of capital, 11 cents, 1,000% return. Your maximum at risk, $11. So here's what it looked like on the option. Here's your chart of the actual stock, and here's the chart of the 110 calls. See, at 11 cents, exploded to 174. So they do happen. So in summary, the dynamics of these short duration weeklies offer you some unbelievable trading benefits. The ability to make money with low risk, low capital requirements, short time frame for trading, higher profits, higher returns, and a lot of different option opportunities each and every week. So I hope you guys got a lot out of this today, and I hope you'll come visit me at Power Cycle Trading. Also, please take advantage of my free giveaway, and let me give you that URL one more time. Let's see here. Let's see. Well, let's see. Oh, thanks a lot, Morgan. So yeah, go there, and you'll get that free course. And if you'd like to take advantage of the earnings course, it's a really good earnings course. Just take advantage of that code. So thanks again. Good luck trading tomorrow. If you have any questions, you can always get me at support@powercycletrading.com. and here's, that freebie there, and support at powercycletrading.com. I don't have that URL, just put it in here, support at powercycletrading. Hey, thanks again, Morgan. He's faster than me. The freebie was the option trading made simple right here. So if you just put in that URL into your browser, powercycletrading.com/pub2, you'll get this special for free. It's my course, Option Trading Made Simple. If you want to buy it, please do. It's $197. I'd love for you to buy it, but it's free for you guys today for a special price of nothing. Summertime special. You can't get better than a freebie, can you? So just put that in. There's the URL. Put that into your browser, and all you have to do is put your name, email address, courses are yours, videos, and everything else. Can't beat 100% off. Nope, you can't. So anyway, you guys, any questions? I think I'm out of time, but yeah, it's all emailed to you. Yeah, it's emailed. It's all digital, so you'll get it right away. So put it in there, and it's instant access. All right, well, thanks again for having me here today, and good luck trading tomorrow, and work on your trend lines. Thanks again. Bye.
All right, great. Thank you, Larry. We greatly appreciate you being here, and look forward to having you back again. Hope that you guys enjoyed today's class, and definitely take Larry up on the offer to get the Options Trading Made Simple course. So we'll get a copy of this recording posted hopefully very soon for you guys. And again, we hope that you have a wonderful, wonderful evening, and we'll get this recording emailed out to you. So our next event will actually be this Saturday, and I'll type in the link for that. Go to tradingpub.com/events and click on that and join us this Saturday for a free half-day class. So thanks again, Larry, and you guys definitely go to his site, learn some more, and you'll continue to grow in your trading by sticking with Larry. Thanks again. Bye.